Hey folks, Manley Haines here. Getting the keys is exciting, but keeping the monthly payment under control, that's where the real strategy starts. In this mega episode, we're building your 2026 Wisconsin and Insurance Survival Guide. We'll cover rising insurance costs, roof rule changes, property tax surprises, PMI, divorce and mortgage issues, and the big move-up question. Are you really trapped by your 3% rate? We'll also talk about why waiting for the perfect rates could cost you and why winter buyers may have an edge. Let's cut through the noise and help you avoid the payment traps. You have a fixed rate mortgage. Your interest rate didn't change. Your loan didn't change. You didn't refinance. So why did your payment just jump up by $130 a month? This catches Wisconsin homeowners off guard every single year. The good news is, once you understand the math, it's not nearly as scary as it looks. Howdy folks, welcome back to the Manley's Mortgage Minutes, powered by the Mortgage 101 podcast. I'm Manley Haines, and every week we cut through the noise and help you understand what is actually happening with your mortgage. Today, we're answering one of the most common questions I hear. Manley, I have a fixed rate mortgage. Why did my payment go up? Well, let's break it down. Here's the first thing you need to understand. A fixed rate mortgage does not mean your entire monthly payment is fixed forever. Your principal and interest payment is fixed. That's the portion that doesn't move. But most homeowners also have property taxes and homeowners insurance built into their payment. Those dollars go into an escrow account. Think of that escrow account as a holding bucket or a savings account. Every single month, you contribute a portion of your annual taxes and insurance, so when those bills come due, your lender pays them from that account. Simple enough until the tax bill changes. All right, let's make this real. Say you purchased a $425,000 home in Waukesha County. All right, so when you close, the annual property tax bill was $6,800. Divide that by 12 months, and now you're putting roughly $567 per month into that escrow bucket for taxes. Now let's say that property is reassessed and the new bill comes in at $7,600. That's an $800 annual increase. Here's the part that catches people off guard. That $800 increase can affect your payment in two ways at the same time. First, your escrow account may have a shortage because it was collecting money based on the old tax bill. Second, your lender now has to collect enough money going forward to cover the new tax bill. Here's the math. The $800 shortage gets spread over 12 months, so that's approximately $67 per month. Then your regular monthly tax escrow increases from about $567 to $633. That's another $66 per month. Add those together and your payment increases by about $133 a month. Your interest rate didn't move an inch. The increase came from your escrow account. Now here's the good news. After you catch up on the shortage, that temporary $67 portion should fall off. Your payment may settle back down the following year, but it will likely settle in at a higher amount than where you started because tax bills themselves are still going higher. And that is the big ticket item. Part of your payment increase may be temporary, but part of it may be permanent. You need to understand the difference. So, what's the move? First, when you buy a home in Wisconsin, do not build your budget only around the seller's old tax bill. Give yourself a little cushion. Second, when your escrow analysis arrives, read it. It will show you whether your taxes changed, whether your insurance changed, and whether you're going to have a shortage. Third, you may want to have the option to pay the shortage in one lump sum instead of spreading it over 12 months. That will not eliminate the higher tax bill, but it may reduce the temporary monthly spike. So here's the bottom line. A fixed rate mortgage locks in your interest rate. It doesn't lock in your property taxes, and it certainly doesn't lock in your homeowner's insurance. It does not guarantee that your total payment stays exactly the same forever. The fix is not to panic. The fix is to understand the numbers and prepare ahead of time. You might find the perfect home, get a great interest rate, and you think you can easily afford the monthly payment until the insurance quote comes back 25% higher than you budgeted for, and your debt-to-income ratio blows up 3 days before closing. Today, I'm pulling back the curtain on the escrow trap and showing you the one phone call you must make before you ever write an offer on a house. Let's talk about the fantasy world of internet calculators. You plug in a purchase price, a down payment, interest rate, and Zillow tells you your estimated insurance is $115 per month. Sounds great. Here's the problem. That's a national average. It doesn't know your zip code, your roof age, your siding type, or your claims history, local storm trends, or replacement cost inflation. In 2026, insurance premiums are not what they were even 3 years ago due to inflation, due to extreme weather payouts, due to rising material costs. That $115 estimate, it actually might be $225, maybe $350, maybe $425 per month. And that difference is not small. That's budget breaking. Let's talk about something called debt to income ratio. DTI. This is how lenders determine if you qualify. We take your monthly debts, plus your new housing payment, and we compare it to your monthly gross income. Now here's the kicker. If the insurance comes in $100 higher per month than expected, that $100 counts against your qualifying income. It's not optional. It's not negotiable. It's math. And that $100 difference can literally turn approved into denied 3 days before closing. That's no good. That's what I call an escrow trap. Not because escrow is bad, but because buyers underestimate what goes into it. Now let's talk about right here at home. In Wisconsin, replacement costs for roofs, siding, windows, they've all gone up dramatically. Labor costs are up, material costs are up, storm claims are up. Insurance companies price based on replacement risk, not based on what you hope it costs. So if you're looking at a house with a 17-year-old roof, older siding, and a prior claim, your premium is going to reflect that, and Zillow has no idea. All right, here's the solution. And it's simple. Don't wait until you're under contract to get a quote. The same week you get pre-approved, call a local independent insurance broker. Give them the address of the homes you're considering, year built, roof age, square footage. Get real quotes, not guesses, not averages, not internet estimates. Real numbers, because when you build your mortgage strategy, we need real math. A lot of lenders wait. They plug in a placeholder number. They hope it works out. I don't do that. I want your deal clean from day one. No surprises, no scrambling, no heartbreaks just before closing. Transparency wins every time. One size never fits all, and an internet calculator will never know exact tax and insurance rates for the specific zip code you want to live in. I've got Craig Sweeney here with Mighty Dog Roofing. This is his world, and when he told me this, I said we need to get this on camera right away and just get it out to the people. Craig, what changed?
Well, thanks, Manley. As of March 18th, Fannie Mae and Freddie Mac both are now allowing something called actual cash value. That's ACV for short, for roofing coverage. Sounds technical, but it's actually a pretty big deal.
Let me frame that real quick. Historically, lenders want full replacement coverage on roofs. Now there's more flexibility, but that also means more risk is shifting to the homeowner, which is you. Let's break that down like I'm a 5-year-old, Craig.
That's funny because sometimes you act like a 5-year-old, Manley. So 2 buckets, Manley. Full replacement coverage, where insurance pays to replace your entire roof, or ACV, like I just talked about, which is actual cash value, where they pay you what your roof is worth today, after age, after wear, and after depreciation.
Hey, Craig, give me a real-life example, because that was a lot of mumbo-jumbo. Bring that down to something that just happened recently, especially with all these storms we've had, and I think we're going to get pummeled again tonight.
I think we are. So let's say you've got a 15-year-old roof, a storm rolls through like last night or tonight. With replacement coverage, you're probably in good shape. With ACV, or actual cash value, you could be writing a pretty big check.
Yeah. Hey, same house, same storm, totally different financial outcome. That's where people are going to get caught. Let's bring this into a real transaction. You've got a buyer under contract, inspection comes back, the roof is older. Now what happens?
Now insurance becomes the question, and that's where things can get messy. Renegotiations, credits, even deals falling apart.
Oh my gosh. And yeah, from the lending side, anything that creates uncertainty or insurance that causes friction late in the deal, this is where things break and get super messy. What are smart agents and the pros that you work with doing differently?
They're getting ahead of it. Quick roof check, clear answers early, no surprises.
Yeah, get your people out there now. That's the play right there, because the worst time to learn this stuff is
during a claim,
right
or
in the last
5
minute.
days before closing.
Yeah, right before closing, and right at the last minute. This isn't about scaring people, is it, Craig?
No, it's not. It's just being aware, staying in control of the situation.
Yeah, if you're a homeowner or a buyer or a realtor and you know what coverage you have or the condition of your roof, you know what your actual exposure is.
Yeah, no, absolutely. And if you don't know, that's what we're here for. You know, Manley's going to handle the mortgage side, I'll handle the roof side, and together we're going to keep deals clean and people protected.
Yeah, let's go get it.
Let's go.
Folks, I have a special guest here. I want to introduce Craig Sweeney with Mighty Dog Roofing. Craig, thanks for coming on the show today. Manley's Mortgage Minutes. We just did a little quick subject about insurance and how it's changing with Fannie and Freddie and all that kind of stuff. We just did a great little run through on that. But I just wanted to give you an opportunity to say a little bit about yourself, say a little bit about Mighty Dog Roofing.
Well, I guess first off, thanks for having me. I've been looking forward to this for months and known you for years, known your business for years, and a great job you do for your clients. You know, a little bit about Mighty Dog Roofing. We're a local roofing company, locally owned roofing company, but backed by the national buying power power of a national brand, right? So Mighty Dog Roofing is a full-service roofing company, both residential and commercial, working a lot with residents in southeast Wisconsin. I focus a lot in Lake Country, Waukesha County, and Milwaukee County, of course. But certainly, I'm in your backyard. So when you're looking for a roof replacement, roofing repairs, or anything due to, weather-related situations, I can help you. We deal with both insurance companies. We have a department that only deals with insurance. We call that our insurance department.
There you go.
Which makes sense, right?
Makes sense, right?
Makes sense. What that means is a client doesn't have to worry about filing their claim, about really, looking at what the estimates are from both us as well as the adjuster. So, we take it from soup to nuts. They don't have to worry. They get a new roof, they get a replacement, they get a siding replaced, whatever it may be that they need, we can take care of it.
Awesome. So how long have you been involved in this business?
So I personally have been involved for 3 months.
Okay.
The Mighty Dog Roofing team here locally, the team that's on the ground, boots on the ground, the production team, has been around for 22 years locally.
Okay.
And 5 years as Mighty Dog. Production team is fantastic. We've got crews that are unbelievable, all local crews, so we don't import folks from out of state, which is important. Storm rolls in like it might tonight. Something you want to be wary of is these out of state, what we call storm chasers. Those are the folks that you want to be wary of because they might give you a good price on a roof, but you don't know what you're getting, and when they're gone, they're gone.
They're gone. They're not like the folks you saw in Twisters that were storm chasers. That were to the cool storm chasers.
Exactly.
Bolted the truck to the ground where the tornadoes came whipping through.
Yeah, those were the cool guys.
Those were the cool guys.
Absolutely.
These guys, not the cool guys.
Not at all. Not at all.
Know who you're dealing with. I've known Craig for a long time myself. Whatever he's involved in is always going to be great. It's going to kill it. Looking forward to doing much more stuff with you, Craig.
Looking forward to working with you going forward and helping your clients out, Manley.
Yeah, appreciate you being on the show here with me.
Absolutely. Anytime.
$550,000 home in the northern Chicago suburb gets you around 2,200 square feet, a 2-car garage, and a property tax bill knocking on the door of $12,000 a year. That same $550,000 in Waukesha County, you're getting more house, lower taxes, and a monthly payment that's hundreds less every single month. So today, I'm breaking down exactly what it costs to buy a home in the Milwaukee suburbs in 2026. So you're not guessing, you're making a calculated move. Welcome to Manley's Mortgage Minutes. I'm Manley Haines. Every week, I break down what actually is happening in the market. No fluff, no noise. That way you can move forward with confidence. Now, today's episode is for you if you're relocating. And here's what I'm seeing. Buyers come in thinking they understand the price point, they haven't run the real numbers yet, and once they do, things move fast. By the end of this video, you'll know what $500 to $600K actually buys here. You'll know what your real monthly payment looks like, and the one number most Chicago buyers underestimate that completely changes the game. Why Milwaukee suburbs? Why now? Milwaukee doesn't always make national headlines, but in 2026, it is. Zillow has ranked it one of the hottest markets in the country, and that's not by accident. Here's the reality. Milwaukee County median home price is about $265K. Waukesha County median is around $420K. That's still a fraction of what you'll pay in Chicago suburbs. Now, the areas that people are targeting are communities like Brookfield, Pewaukee, Menominee Falls, Waukesha, and Oconomowoc. Why? It's simple. Strong schools, easy commutes, a real community feel. And here's the key. At $550K, you're not scraping the bottom of the market here. You're stepping above the average. That's a completely different buying position than Chicago. What your budget actually buys. Let's make this real. In Brookfield, one of the most established suburbs in Waukesha County, $550K can get you a 4-bedroom home, a 2 to 3 car garage, a finished basement, and a solid lot. There aren't starter homes here. These are long-term family homes. Pewaukee, it's a slightly hotter market. The median right now is about $600K. So at $550K, it's competitive, but it still gets you in the door. Oconomowoc and Lake Country, more land, more space, more lifestyle. But budget about 40 minutes drive time to downtown Milwaukee from out there. Menominee Falls, the sweet spot. Value plus proximity. All of these sit within 25 to 40 minutes of downtown Milwaukee, depending on where you land. And if you're bouncing back to Chicago occasionally, Milwaukee's Amtrak station is a short drive from most of these suburbs. 7 round trips a day to Chicago's Union Station, about 90 minutes each way. The lifestyle shift is real and practical. The real monthly cost breakdown. Let's talk about the numbers that actually matter. The monthly payment. Let's run a clean example. $550,000 purchase, 10% down or $55,000, a loan amount of $495 at roughly 6.3% rate. Principal and interest payment is about $3,070 a month. Now, here's where Wisconsin changes the equation. Property taxes in Waukesha County sit around 1.01%. That works out to be $5,500 a year or $462 a month. Add insurance and call that $150, so your total monthly payment lands you right around $3,700. Now compare that to Illinois, where Collier County property taxes rates run around 2.1%. That same $550,000 home across the border is generating roughly $11,550 a year in property taxes, nearly $970 a month. That's over $500 more every single month. Same price, same lifestyle, different state line. That's where the real arbitrage happens. The core message: here's the bottom line. This move isn't just geographic, it's financial positioning. You're not just buying a house, you're upgrading your space, your monthly cash flow, and your long-term equity position. And the buyers who understand that, they don't sit on the sidelines, they move with intention. If you're considering a move to the Milwaukee suburbs, the worst thing you can do is guess your way through it. Run the numbers, understand your payment, know your buying power, because once you see it clearly, the decision becomes a whole lot easier. Maybe your family grew, maybe you're working from home now, maybe you'd like to move into a better school district, but every time you look at today's mortgage rates, you look at the same thing. I'm not giving up a 3% loan. So you stay put even though the house doesn't really fit your life anymore. Here's the thing. In 2026, there's actually a few smart ways to move up without wrecking your monthly budget. And today, I want to walk you through what those options can look like. Number 1, acknowledge the pain. Let's just say it out loud. Giving up a 3% mortgage rate feels very painful. It feels like you're making a bad financial decision. And honestly, that's understandable. A 3% mortgage rate is historically low. Rates like that don't come around very often. But there's a deeper question most homeowners don't ever ask themselves. Is your mortgage rate helping your life? Or is it keeping you stuck in a house that no longer fits for you and your family? Because at some point, your home needs to match your life in the life you're living today, not the life you had 3 years ago. Number 2, the equity flex strategy. Here's what many homeowners overlook. While mortgage rates went up, home values also went up. If you bought or refinanced in 2020 or 2021, there's a good chance you're sitting on a lot more equity than you realize. For some homeowners, that could be $100,000 or $200,000 or maybe even more. That equity creates flexibility. Let's say you sell your home and walk away with $175,000 after paying off the mortgage. Instead of borrowing $600,000 for the next house, you might only need to borrow $425,000. Yes, the interest rate might be a little higher, but the loan balance is much smaller, and the smaller loan balance can make the payment far more manageable than people expect. This is what I call the equity flex strategy. You're trading a lower interest rate for a much smaller mortgage balance, and sometimes the math works out better than homeowners think. All right, number 3, the accidental landlord strategy. Now let's consider another option. Instead of selling your home, what if you kept it? A 3% mortgage today is incredibly low compared to current rental prices in most markets. In many situations, homeowners can rent out their current property and cover the mortgage, the property taxes, and insurance, and sometimes even generate a little cash flow. Now that home becomes an income-producing asset, and that rental income can help offset the payment of your new home. So instead of losing your 3% mortgage, you keep it. This is often called the accidental landlord strategy. It's not the right move for everyone, but it's a strategy many homeowners don't realize they have. So you might be wondering, if I'm going to buy another home, I'm going to keep this one, where do I come up with that down payment? That's a great question. We should talk and come up with a strategy based on your specific situation, because it's not one size fits all, and it's why we lenders exist. All right, number 4, the life factor. Let me ask you a different question. Is saving a few $100s a month in interest worth kids sharing rooms when they don't have to? Working from the kitchen table instead of having a home office? Driving an extra 30 minutes every day because you want a better school district? Feeling cramped in your own home? Look, the math matters, but so does quality of life. You can't put a price on things like more space, more comfort, less stress, more time with your family. Your mortgage rate is just a number. Your family's lifestyle matters more than that. The real answer is a custom strategy. The truth is, there isn't one answer for everyone. Some families should stay where they are. Some families should sell and move up. Some should keep their home as a rental and buy something new. But the biggest mistake I see homeowners making right now is doing nothing, simply because they're emotionally attached to a 3% mortgage rate. In many cases, you can actually have more equity, more leverage, and more options than you realize. You just need to look at the numbers. Don't let the math equation dictate how your family lives. you're likely to have more equity and more options than you realize. In this video, I'm going to show you the exact math and why waiting for 5% interest rate will actually trigger a bidding war that wipes out every single dollar you thought you were saving. Let's look at the numbers. Let's start with what nobody's talking about. Everyone has the exact same plan. Manley, I'm just waiting for rates to get back into the fives. Okay, now imagine this headline hits. Mortgage rates drop to 5.99%. What happens? The buyers who paused in 2024, the buyers who gave up in 2025, the buyers living with the in-laws, and the buyers tired of renting, they all jump back in at the exact same time. That's not a balanced market. That's a stampede. Now let's talk real math. Right now, maybe 2 or 3 buyers are competing on one solid home. At 5.9%, it's about 10. And when 10 buyers want the same house, the price doesn't stay flat. It goes up, not by $5,000. I'm talking 15, 20, 30, maybe even more than $30,000. You think you save money by waiting? Let's break that down. Let's say today, a purchase price at $400,000, an interest rate at 6.375 versus waiting for a purchase price at $430,000 after the bidding war and a rate of 5.99%. Yeah, your monthly payment might be lower by about $150 with that rate. And it sounds great, right? Except you just overpaid by $30,000. At $150 per month savings, it will take you 16 years to break even on that. 16. Most people refinance in 2 to 5 years. So tell me, did waiting actually help? Or did it quietly cost you your wealth? Here's the truth. Most people ignore. You can change your interest rate. You can never change your purchase price. You date the rate, you marry the house. If the rate drops next year, you refinance. If prices rise next year, you're stuck paying the higher price. Buying now when competition is manageable locks in the asset. Waiting locks you into a bidding war. The real trap isn't the math, it's fear. It feels safe to wait. But markets, they don't reward comfort, they reward strategy. Right now, we have cautious buyers, selective sellers, and negotiation room. At 5%, that window slams shut. All right, you can't time the market or the bottom of the market, and trying to guess what the Fed will do next is gambling with your own family's budget. Every year, folks assume spring is the best time to buy. More listings, more sunshine, more options. And while that's mostly true, it comes with the summer surge that nobody budgeted for. In this video, I'm showing you the real data from Wisconsin Realtors Association and why braving the cold today might actually leave you enough room into your wallet to buy a new car or at least one heck of a grill. This is Manley's Mortgage Minute, powered by the Mortgage 101 podcast. I'm Manley Haines, and today we're looking at the real price of spring. Look, we all know listings are lighter in the winter, but the hidden truth, they're also cheaper. According to the WRA's Seasonal Trends Report, homes sold in peak summer months, June and July, go for about 6.4% more than the yearly average. Let's say you're eyeing up a $600,000 home in Waukesha. That seasonal premium is over $40,000. That's the summer sunshine tax. Same house, higher price, just because you waited for better weather. And it's not just price, it's pressure. In January, you might be the only offer. In April, buyer traffic jumps almost 45% per the NAR. That means open houses packed like a fish fry, multiple offers, waived inspections, and offers way over list. So it's not just what you pay, it's what you give up to compete. All right, let me show you how this plays out. In February, that $600,000 home hits the market. You might be the only offer. You might write at or just under asking. Ask for just a rate on test, negotiate a few things, you get the house. Come April, nothing about the house changed, but the buyers did. Everyone who waited jumps back in at the same time, and suddenly there's 8 offers, and that $600,000 house sells for $640,000 now, or even $650,000. You just paid $40,000 or $50,000 more for the exact same 4 walls, just because you waited for sunny skies. And here's where the math gets mean. Let's talk monthly payment. Right now, rates are in the low 6s. If you wait for spring, here are 3 scenarios, and a spoiler alert, none of them are doing your budget any favors. Scenario 1, rates stay flat. This is most likely even if rates don't move at all, but if you pay that $40,000 spring premium, your monthly payment jumps $240 to $300 just because you borrowed more. Scenario 2, rates drop 0.25%. This is what people think is the dream scenario, but the math doesn't work out. Look, Let's say the market throws you a bone and rates fall a quarter point. That helps, but it's still not enough. You're likely still paying $150 to $300 more per month because you got bid up. All right, scenario 3, the double whammy. This one stinks. If inflation ticks up and rates rise 0.5%, and you also pay that spring surge, your payment could jump $400 to $500 a month versus locking something in right now. That's not fear. That's just math, principal and interest, and timing. You're not betting on better weather. You're gambling with your long-term payment. All right, the strategy. So here's the move. Don't wait for the thaw. Look at the listings that have been sitting around for 45 to 60 days. Those sellers, they're cold, they're tired, and they're ready to deal. In real estate, motivation matters. And in February, motivation is high. Now look, I get it. Not everyone can make a move in winter. School schedules, life, logistics. But if you can move early, do it. Don't fear winter. Leverage it. Hey folks, welcome to Manley's Mortgage Minutes. I'm Manley Haines, and every week I help you cut through the confusion around mortgages, housing, and what's really happening here in Wisconsin so you can move forward with confidence. Today, we're tackling a topic that comes up more than you'd think: marriage, divorce, and your mortgage. Because life changes happen, and when they do, understanding how they affect your financing can save you stress, surprises, and costly mistakes down the road. Let's jump in. First, what happens to your mortgage when you get married? The good news, if you already own a home and have a mortgage before getting married, nothing automatically changes. The loan stays exactly as it is. Your interest rate doesn't change, your payment doesn't change, your loan terms don't suddenly shift because you said, I do. If the mortgage was in your name before marriage, it stays in your name. Where things do change is when you apply for something new. Maybe you're buying a house together, maybe you're refinancing, maybe you're upgrading your homes. That's where your financial picture starts getting looked at differently. And here in Wisconsin, there's an important wrinkle people don't always know about. Wisconsin follows the Wisconsin Marital Property Act, which means certain mortgage rules work differently here than in many other states. For government-backed loans like FHA, VA, and USDA, lenders may have considered debts belonging to other non-borrowing spouses, even if that spouse isn't even applying for the loan. Let me make that practical. Let's say you qualify on your own. You've got solid income, good credit, and you're applying solo. But your spouse has monthly debt obligations. In some cases, those obligations still get factored into your qualifying, and that can impact your buying power, monthly affordability, and even program eligibility. That doesn't mean you can't buy, it just means strategy matters. This is why getting educated before you start shopping matters so much, because small details can change outcomes. And here's another Wisconsin-specific item many people never hear about. Even when a spouse isn't on the loan, they may still need to sign mortgage-related documents. Not because they're responsible for making mortgage payments. They're not, because Wisconsin law recognizes marital property interest tied to the home. Translation: build a little extra time into the process, and don't panic if your lender says your spouse needs to sign the paperwork. That's normal here. Now let's talk divorce. This is the part where confusion causes real problems. If both spouses are on the mortgage, both people remain legally responsible for the payment even after the divorce is filed. And this is important. A divorce decree itself does not remove someone from the mortgage. Neither does a quitclaim deed. I see this misunderstood all the time. Someone signs over the ownership rights to their home and thinks, okay, I'm done. But from the lender's perspective, not necessarily. Here's the difference. A quitclaim deed changes ownership of the property. The mortgage is a completely separate agreement. If your name is still on the loan, you're still tied to that debt. That means missed payments can still affect your credit. The mortgage may still count against you when qualifying for another loan. And financially, you may still be carrying risk that you thought was gone. So what actually removes someone from the mortgage? There's really two clear paths. Option 1, refinance. The spouse keeping the house refinances into their own name and qualifies independently. The old mortgage gets paid off and replaced. Now responsibility belongs to one borrower. Option 2, sell the home. The property sells, the mortgage gets paid off at closing, and both parties move on cleanly. Simple. Not always emotionally easy, but financially clear. And if I can give you one piece of practical advice here, don't wait until after the divorce to finally figure this out. Have the mortgage conversation early. Know what's realistic. Know who qualifies and know what options are actually out there before the decisions are permanent. So here's the bottom line. In Wisconsin, marriage can affect mortgage qualification even when your spouse isn't on the loan. And during divorce, Paperwork through the court system does not automatically remove you from mortgage responsibility. A refinance or a sale is what actually resolves it. The good news is, when you understand the rules and you can plan for them and move forward with confidence instead of confusion. Today we're talking about PMI, what it is, why it exists, and what it actually costs. And most importantly, how you stop paying for it. Because here's the good news. PMI is not forever. By the end of this, you'll know if you're paying it, how long you'll be likely to have it, and the smartest way to remove it sooner. So let's start with the simple one. PMI stands for Private Mortgage Insurance. And despite that name, it's not insurance for you. It protects the lender in case the borrower defaults on the loan. On a conventional loan, PMI mortgage typically comes into play anytime you put less than 20% down. Now, before you think that doesn't sound fair, let me give you some perspective. This isn't punishment, it's simply how the mortgage system manages risks. If you're putting less money down, the lender is taking more risk because there's less equity in the home at the start. PMI helps offset that risk. In exchange, buyers can purchase a home sooner instead of waiting years to save up 20%. And for many buyers, that trade-off makes sense. Now let's make it real. Say you're buying a $350,000 home somewhere in Metro Milwaukee, maybe Muskego, New Berlin, or right here in Waukesha County. You put 10% down or $35,000. That leaves you with a loan amount of $315,000. PMI on a conventional loan is dependent on things like credit score, down payment, and debt-to-income ratio. For this example, we're going to use a 740 credit score with a debt-to-income ratio of 40%. That works out to about $756 per year, or roughly $63 a month added to your payment. Yeah, that's real money, but it also helps you keep $35,000 in your pocket. So, if you're buying a home, this is something you want to plan for and not be surprised by. Now, here's where a lot of people get tripped up. They think PMI lasts forever, and it doesn't. In fact, there are 3 ways to get rid of it. Number 1, automatic cancellation. The federal law requires lenders to automatically remove PMI once your loan balance reaches 78% of the original home purchase price, assuming you're current on all your payments. That happens naturally over time as you pay down your mortgage. You don't even have to request it. But depending on your loan structure, the timeline could be several years. For many buyers, it might take somewhere in that 8 to 11 year range if they simply let the mortgage run its course. All right, number 2, request cancellation at 80% loan to value. This is where paying attention matters. You don't have to wait for the automatic removal. Once you hit that 80% loan to value, meaning you've built up 20% equity based on the original purchase price, you can contact your lender and request PMI cancellation. You'll generally need a solid payment history, and sometimes the lender may ask for an appraisal. But this is one of those moments where being proactive can save real money. Don't assume that the lender is going to call and remind you. Keep an eye on it. All right, number 3, appreciation-based removal. This is the one that matters in most markets like ours. If your home is appreciated in value, which many homes in Waukesha County and across southeastern Wisconsin have over the last several years, you may have reached 20% equity much sooner than expected. In that case, you may be able to request an appraisal, document the updated value, and ask your lender to remove the PMI early. That can potentially shave years off the timeline. And honestly, this is the one that many homeowners overlook. If you've bought in the last few years and you haven't looked at what your home may be worth today, it's worth a quick conversation. So here's the bottom line. PMI is not a forever payment. It's a temporary cost that gives buyers an opportunity to get into homeownership sooner without waiting years to save for the full 20% down payment. The important part is you understanding the exit strategy. Know your loan balance, pay attention to your home value, and when it gets close to that 20% equity, be proactive. The people who pay PMI longer than they need to usually aren't doing anything wrong. They just didn't know they had options. Now you do.